Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for August 2nd of 2021. Please see our disclaimer for important information. Well, as we get started with the news you can use this week, here's our high frequency data provided to us by our friends at First Trust Advisors in Chicago. You can see on the month-over-month change, by and large, good information. However, we are beginning to see a little bit of an impact perhaps in the rise of the Delta variant in cases and areas that are moving to higher stage levels of acuity, although I don't think we're going to be seeing lockdowns, but there's maybe a little bit of an impact on the number of people that are going out and a little bit of an impact on activity. You can see that in the open table. Restaurant industry data, which is down slightly in the week, as well as TSA checkpoint data. We are in kind of the middle of the summer and the peak travel season. Supply of motor gasoline still remains positive, but global commercial flights are down a little bit. But really nothing that gets me really concerned. We did have a tail down in rail car traffic, and it's looking a little bit softer. I think that has a lot to do with some supply chain choke points, as we'll see later on in the chart pack that we've had a rather significant drawdown of inventories, which I would expect once those bottlenecks are resolved, the railcar traffic should see a fairly dramatic rebound at some point. But labor data continuing to track reasonably and kind of within expectations. Here's some isolated charts on some of those high frequency numbers. You can see box office receipts, a little bit lumpy, kind of dependent on new releases, and we've had several lately. Rail car traffic, you can see where that's really began to overlay 2019, and now it's kind of trailed off a little bit. Again, I think it has a lot to do with supply chain issues. Steel production up, hotel occupancy up, and then open table, as we just mentioned, was down slightly for the week, and you can see that kind of attenuating a little bit in terms of its rise, and then TSA checkpoint data also beginning to level off a little bit at levels below 2019, but we are allowing for more airplane inventory onto the market. We've got a slide here that I just wanted to highlight, as we talk about the rise of cases related to the Delta variant and the unfortunate deaths that are associated with that. Without getting into the weeds on the actual clinical data, it's clear that a very, very high majority of those cases are tied to people who have not been vaccinated. And so this is a pretty interesting trend that was provided to me via Daily Shot. And it gives you a snapshot across several countries, as you kind of track from the beginning of the year to where we are now here. And some of this data is maybe lagged by a month or so, but there's a real clear trend as this Delta variant begins to pick up speed, and it's a lot more communicable, and the symptoms can be more severe than even the initial variant of the virus. That you can see concurrent with that is actually a really strong downtrend across many countries in the interest level of folks to be vaccinated. So we know some countries are I'll just call it more vaccinated than other countries, but this is kind of reflective of that population that has yet to be inoculated, what their feelings are in terms of getting the vaccine, and you can see here that's it's trending down. So I guess, the one key takeaway is that, Delta is just one of several. And a couple of weeks ago, I showed you a chart of the various variants that are out there. Delta just happens to be the most prevalent one right now. In fact, you could probably bone up on your Greek alphabet by looking at all of the variants that are in existence right now. But I think what this tells you is you've got a really inflexible part of the global population that it just has an aversion to getting vaccinated, at least right now. And so, perhaps, we're going to have lingering impacts from this pandemic for some time because of this. because of the fact that the people that are getting sick now are the ones who are unvaccinated. Here's a quick chart from Fidelity Pack, which gives you some consensus numbers, and this is Federal Reserve as well as Bloomberg, which is a consensus of a lot of different forecasters. But we've got GDP, unemployment, and inflation. Up top is GDP, which is basically our economy. You can see how that tracked through 2020. We were down 2.4% net of all of the huge activity that we have during that year. But then 2021, we're expecting about 6.6, and then that trends down to a more normalized level of maybe the middle 2% range when we get out into 2023. So no surprise, both the Federal Reserve and Wall Street expect those to trend down and kind of normalize over time. So as we talk about slowing, we talk about peak growth in our economy. It's not a term that should be feared because there could be a lot of staying power in terms of our economic growth cycle, as well as our stock market, as well as business expansion. All of those things can persist well past the peak growth rate in terms of our economy. Now you go down to unemployment rate. Obviously we've had some positive traction here in the unemployment rate. Actually ended the year last year at 6.7%, which is much, much lower than I think a lot of people would have ever thought back in late spring and early summer. But again, you see here getting into the forecast, both from Wall Street and the Federal Reserve, that those numbers are expected to continue to trend down, even kind of revisit and surpass levels in 2023, perhaps, where they were pre-pandemic. And finally, down at the bottom is the inflation forecast. And so, looking at the historical data from 2017 to 2020, we just really haven't had inflation, and we've really enjoyed this level. And this chart probably does as good a job as any chart that I've shown you lately on the theory that I have had for months now, that we're going to have an attenuation in the current inflation levels. 2021 as a whole is going to be much higher than we've experienced in a long time, but then we settle back down and we get down to levels that are more what I'll call the new normal moving forward. And I think we're going to have levels of inflation that are higher than what we've experienced. And if you look at the last 4 years, really only 2018 was above 2%. And that was a consumer price index, and core prices were actually lower than that. But in 2023 and 2022, you can see those levels being a little bit higher than that, which is very much within, I think, reason here. Here's a quick check-in on the Conference Board Consumer Confidence Survey Index. And despite the Delta variant, maybe what you see in perhaps some of the high frequency data, consumer confidence remains relatively strong. Expectations, it continues to be bolstered by income growth, by equity gains, and confidence remains pretty high right now. Here's a quick check-in on the latest GDP figure. So it was reported last week, second quarter economic growth on an annualized basis was reported at 6.5%. So there were several surveys. Wall Street Journal had expected 9.1%. I enclosed that highlighted survey. That's a Bloomberg survey that I overlaid on top of this chart, which was 8.4. But regardless, 8.4 to 9.1. GDP didn't hit expectations, and a lot of that actually had to do with inventory, and we'll talk about that in just a second, because we are really in a dislocated position with regard to inventory for sale, raw material inventory. On an inventory basis, usually you get a contribution when you're in a new economic cycle, because you're building inventories for expected increases in sales, and we just don't have that now. But we'll talk about that in a second. You can see in the red, those are forecasts. Again, getting back to this notion that we might be at a peak growth situation, and that's okay. We can still grow for a long time afterwards, like I said, but that's reflected on the left-hand side. On the right-hand side shows you what the actual economic output number looks like. The ones on the left are percentage movements, and the ones on the right are actual numbers. So, even though we did not surpass expectations on the GDP number, the actual economic output is surpassed pre-pandemic levels. And if you go down on the bottom, what that shows you is even though we've surpassed prior levels, we've recovered fully from the depths of the pandemic, we're still well below this trend line that was established pre-pandemic. And so, we have several, I'd say probably at least a couple of years worth of growth, at least 18 months worth of growth to kind of catch back up to that. Here's a quick snapshot of the components to GDP. Really, the main thing I want to point out here is in the gray, which is consumer spending. So consumer spending has had a rather pronounced impact over the last couple of quarters in this recovery. Again, owing to the fact that consumer expectations, consumer confidence has been really strong. And also you can see a little bit in that tinge of that green in there. Business investment's been pretty strong too. We have a quick slide on that coming up as well, but those two things in concert have really gone a long way to offset any of the drags on economic growth from other areas. Here's a quick snapshot of consumption related to goods and services, and we talked about this a lot in the past. On the left-hand side, you can see goods consumption has really been outstanding. We've had a little bit of a rolling over, and that has something to do with the availability of product. Goods, obviously automotives are in tight supply right now, so that's had an impact on that rolling over a little bit. But you can see we're well above the pre-pandemic trend, whereas on services, as you might expect, we're reopening the service economy, storefronts and things like that. We're getting more foot traffic. We're heading back towards that trend line, but we're just not there yet. And then if you look on the right-hand side, and this is in capital goods shipments, again, we know manufacturing had really come out of the gate pretty strong, and that's created some logistical choke points in the supply chain. But you can see that in the dotted line and on the right-hand side relative to that green line, which represents the 2008 recovery from that recession. You can see from the moment the recession ended, it did take a while in 2008 to kind of rebuild that capital goods shipments to where they reattained their prior levels. But during the COVID pandemic this past year, you can see the recovery has been much, much faster. As I mentioned, business investment has been very strong. And look, this is the contribution to overall GDP growth. And in each of the last 4 quarters, business investment has really had a positive impact, at least 1 full percentage point to GDP growth. And I would probably expect that to continue based on CEO surveys and obviously on the strength and quality of the balance sheets and of cash flow and earnings on the part of companies. We've got several charts on this. Now, this is really a snapshot on inventories, and this is what I was talking about earlier. We're in a real conundrum here on the advent of this, this new economic cycle, if you will. You can see that the last 2 quarters, on the far left, the inventory contribution to GDP growth has been negative, and it's been negative to a pretty stout level. Last quarter, it was a 1% negative drag. 2 quarters ago, it was 2 full percentage points or greater, even close to 3 percentage points drag on economic growth. And if you go to the middle, this is the Richmond Fed's most recent survey. And this, there's a lot. There's, there's a dozen Federal Reserve districts across the country, and most of the charts look just like this. You've got the raw material inventories that are at just tremendous lows. We haven't seen these numbers in a long time. Down below is the inventory level of finished products, again, at tremendously low levels. And then on the far right, this is just another indicator of that same thing. It's inventory to final sales. And so when that number is low, your inventories relative to your final sales are extremely low. And this is the issue that we've got right now. Now, if you look at the far left again, with these low inventory levels, at some point, if you have demand that builds up in the system and you are in a sustained recovery, at some point, you're going to have to rebuild your inventories. And that's going to be very positive for business investment, capital spending on production to be able to increase that. And you've got to have clean logistics and supply chain networks. And so, it's going to put a lot of pressure in a lot of areas over the next 24 months to kind of work out some of these choke points, because these inventories are going to have to be rebuilt. These levels are just simply too low. And so the read through here is that you're going to likely have a very positive influence on economic growth from inventory building over the next year. Here's a couple of reasons kind of behind this whole inventory issue, I guess. On the upper hand, auto inventory, way down, okay? We'll talk about the chip shortage in just a second, but the auto production has been significantly impacted by several different things, not the least of which is the availability for semiconductors, because there's a much higher semiconductor component contribution to the total vehicle these days. Down on the bottom is net exports. And so, the reason why, that number is so outsized right now, it's a very negative net export is because consumer confidence is high, consumption is high, and there's a huge demand for goods on the part of the buying public. And so we're importing a lot more than we're exporting right now, just purely because of demand. Well, here's that slide from Susquehanna Financial Group that I was mentioning a moment ago about semiconductor lead times. Right now, they're out at almost 20 weeks. You can see how that number just continues to rise. And so, this is essentially, as it says, the gap between when you order a chip and when you actually get it delivered. That lead time is extending. And this is going to be a real issue for manufacturing. And the rise of this magnitude really suggests that it's going to take a while for us to work out these choke points. So, as it relates to automotive manufacturing, that's still going to be tight for some time. As it relates to a lot of the consumer goods, durable goods, washing machines, everything that uses semiconductors, it is going to face some issues related to this chart right here, probably all the way through 2022 to some degree, and maybe even into 2023. All right, now we transition over to inflation. Not a huge surprise. We know that number's been strong. This is the latest core PCE. This is personal consumption expenditures. So, and again, it's core, so it strips out food and energy, which tend to be a little bit more volatile, but PCE, or personal consumption expenditures, is the inflation figure that the Fed pays attention to. And obviously that's been high. Latest reading was 6.1%. We've got some other charts that kind of illuminate some of this in the charts ahead here. A busy chart here, but it just gives you a snapshot of a lot of different CPI components. Where they're on the top row, you've got core commodities, furniture, appliances, and then you can kind of scroll through. You've got new cars, tools, sporting goods, used cars, toys. What this chart does is in the red shaded areas represent the percentage of the time dating back to essentially 1999, if you will, where prices have actually gone down, or they've been in a deflationary mode. And you see, quite often in a lot of these components, these components have spent, perhaps up to half or more of their time in a deflationary cycle. And so, even though prices have moved much higher here lately, that overall, you can see that this is in some respects kind of catching up for lost time, if you will, and especially on toys, you can see in the middle right of your screen, that almost 99% of the time you've had toy prices in deflationary mode, like they've gone down over time, and only lately have they gone up. And so this just shows you two things. One, that prices don't always go up. We're seeing in kind of an interesting time right now where they are, and they're going up by a fair amount, but they certainly don't always do that. I thought this chart was really interesting. Source is JD Power and Associates, and so what we see here is really unprecedented. You actually have a 1-year-old vehicle price on average that's equal to what a new vehicle price is. And the old adage is you drive the vehicle off the lot and it automatically goes down 10%. Well, at least in 2021, that's not the case. And we've seen such a spike in used car prices, especially relatively young used cars, spiked tremendously high. Now they've essentially eclipsed new car prices. All right, commodity spot index, not a tremendous shock. We've got a lot of commodities that go into this number. We have seen actually some rollback in some of the hard commodities. Certainly lumber's come back, iron ore has come back, and but overall commodities remain high. This is probably the most transitory element that would ever find its way into inflation. I'd say wages have a lot bigger of an impact on overall long-term inflation than do commodity prices, but nevertheless, they are high right now. All right, housing, here we go. So the latest reading in the FA price index showed an 18% year-over-year gain. That you can see on the chart. That's a tremendous boost. It's something that's been playing out over essentially about the last 9 months in a very pronounced way. And I do think that there is going to be a day of reckoning, and that comes from the analysis of the chart on the right, which is essentially average hourly earnings relative to purchase price, home purchase price, the index for that. And so that index is in purple, and earnings are represented in the black line. And so that delta has gotten so wide, and of course it happened in the middle 2000s, we saw that gap kind of widen out prices just because the credit was so easy to get, and everyone had the ability to get a house even though they couldn't really afford it. But so it drove house prices up and incomes weren't going up, and so there was certainly a day of reckoning. And I do think, not that necessarily housing prices are going to crash, but I just think the rate of gain is going to slow. And it has a lot to do with this chart because earnings are lagging significantly behind prices, and it's really putting a pinch, especially on first-time home buyers and people that don't have a lot of the liquidity that you need these days to close on a home. This is a quick check-in on rents from Pantheon Macro, and so you can see in the black bar, that's the CPI component that's tied to primary rent, and that's a year-over-year number. Interestingly enough, it's actually pretty low right now, and so we've seen this continuing trend of sorts where last year rent prices were going way down because people, especially the big urban cores like New York, were not renewing leases. They were moving away, moving back home, and basically kind of waiting out the pandemic, if you will. Well, those rents haven't really recovered. And then you've got asking rent, which is really, spiked. And so at some point, this CPI component for primary rent is going to catch back up with this. You can see that, that the trend line for the asking rent is very volatile, moves around, and the CPI number is much more smooth. But you can see the basic trend line. And so where we are now is at a tremendous disconnect. And so the read-through on this is that you're going to have the OER component of inflation, or owner's equivalent rent, or primary rent, known by several monikers, that's going to trend higher in the coming quarters. Here's a quick look I thought was really interesting. Despite the pandemic, we've seen a continued rise in the number of venture capital deals in billions of dollars. On the upper left in the green, you can see that those bars trending into 2021. And that 2021 number, even though it shows kind of a continued trend over the last 4 years, that's only through mid-July. And so, if you annualize that number, that represents a huge spike in venture cap deals this year relative to a year ago. And amazingly, last year was up over 2019. You can see the number of deals by month is up fairly strong. And then on the right-hand side represents private equity. And again, this number is just through the end of June. So if you look at this data, you can tell over the last 3 quarters, it's been really strong, but that last column of Q2 represents it represents a really strong trend if you annualize that number. Here's the Wilshire 5000 index relative to GDP. So this is essentially a valuation relative to GDP. Warren Buffett uses this indicator a lot to kind of help him determine whether the market's a little bit frothy. Wilshire 5000 is not the S&P 500. It's about as complete an index as you can get. It encompasses large, mid, and small cap stocks. It gives you wide breadth. And so even though we've had some weakness in small caps relative to large caps lately, this index is at highs that we haven't seen in an extremely long time in terms of GDP. So the market is accelerating at a faster pace than the economy is, even though, as we just talked about, the economy continues to expand at a pretty reasonable pace, even though it didn't exceed more recent expectations. But this number is going to be, it's curious to watch, and the rate of gain is pretty impressive. I think we have to be cognizant of asset price levels now, especially if interest rates are to rise in the coming year. Then we definitely want to be watching this, because I think multiple expansion will be tougher to come by. It's going to put an awful lot of pressure on earnings to continue the pace of equity growth that we've seen, and I think it probably slows us down a little bit. Again, nothing unnatural, very consistent with how the world is supposed to work. When interest rates rise, you can still have equity growth, but you're just not going to see the rate of gain that we've had over the last year. This is a really kind of a busy chart, but I'm going to explain it like this. So we have had some, ironically, with the low volatility that we've had some really strong moves in the market, but they've been very quick. And that's why that highlighted piece on the far left on this chart, that basically when we've had a massive drawdown, we've had almost a immediate response where the equity market's been bought back. Whereas, if you go back over history and you look at some of these years where we've had a fair number of fairly significant one-day moves downward in the market, it's taken a lot longer to recover that. And so, essentially, this is something that was even established last year when we had really large drawdowns on a 1 or 2 day basis. Generally, within 5-6 days after that, we were right back where we were. And also on this chart, basically says it only took us a little bit more than 2.5 days to recover that massive gain. So with all the data on this chart, that's the takeaway from this, is that we've had some, ironically, some very decent drawdowns, but they haven't lasted very long at all. So a quick look on equities. Again, this is nothing new really. The net percentage on the left of companies with rising profit margins continues to go up. So again, companies are more profitable, margins are going up. And then you can see on the S&P 500 net profit margins on a kind of a trend line basis, you can see how the last 4 quarters have been fairly strong. It didn't take us very long to get back up to profit margin levels that we saw pre-pandemic. And now what's going on is we're seeing those profit margins expand further. So not only are we encompassing more of the companies out there and having more companies enjoy profit margin gains, but we're seeing the average profit margin of the S&P 500 continue to remain exceptionally high. Well, here's a quick look at gold, which has, by this technical analysis, has really kind of consolidated in this 1830 per ounce level. You can see that it got a little bit ahead of itself in late summer last year and consolidated quite a bit. There are obviously some reasons behind that as we shifted from a kind of a crisis or safety of principal mode to to more of a new economic expansion mode. But, I think these prices are consolidating at a level that I think should be sustained for the time being, barring a significant change in US dollar and on economic prospects. And here's a chart that I came across, and I might as well just kind of more or less end on this, but from Bank of America and their analysis, and there was a kind of a seminal publication done in 2005 called The History of Interest Rates. And so I promise you will not see another chart like this in any chart pack. It actually takes you back 5,000 years on interest rates. And I'm not even going to begin to get into the analysis, but I'll give credit to B of A for reprinting it in some of the recent research. But what it does, ironically, is it shows you outside of the Great Depression, we have essentially interest rates that are at their lowest point in over 5,000 years. And you think about that, that's quite a while. Certainly in the modern era, where that second big jump takes place and kind of gets us started at 1720. That date is readily identifiable because the Bank of England certainly kept track of it at that point. And you can see where we are now, there really is no precedent for the rate structure outside of Great Depression. Well, that will do it for this week. I hope you've enjoyed the charts of the week. On behalf of the entire team at BKA, hope you have a wonderful week, a safe week, productive week, and we'll talk to you again soon. Take care. Bye-bye.